for a bit. Over the last 5 years, the financial advice industry has seen a push toward boutique firms as people really started to move away from some of those large licensees. Now, in the current climate, that trend has begun to reverse. To tell us more is Mark Hoven. He's from Advisor Ratings. Hey, Mark, welcome back to AusBiz. Great to have you here with us. So how are you seeing evidence of this? Talk to us about it.
Yeah, so just sort of provide a bit more detail and background on that introduction. Over the last 5 years, we have seen a mass privatisation of the advice industry as advisors have left the major institutions, and a mass miniaturisation is the term I used, because so many of those advisors have been jumping out and setting up their own self-licensed boutiques. And it's at that end of town, that small end of town, that we're starting to see this reversal. So something like 93% of all licensees employ a quarter of the advisors in Australia. So it's a really small market. And what's happening at the small end of town, I like to describe it in these terms: the white knuckle ride of running your own little small business and running your own license is coming to an end. 200 businesses, self-licensed boutiques, shut down in the last 12 months. Now, more than 80% of those had one advisor in them, and 65% of those were only 5 years old or less than 5 years old. So they were very much the cohort that have been setting themselves up in the last few years and ultimately finding it too tough to continue.
Mark, last week we were talking about the tests that financial advisors have to undertake by the end of the year so that they continue to practice. Is that one of the drivers of people deciding it's all too hard and leaving the industry?
I think it's part of it. Yeah, a lot of those businesses that are shutting down will be, by their very nature, being exposed to one advisor, are very much driven by that person's intent. If they're also running the business and believe the study is too much to combine with all the other imposts on them running a small business, that would be understandable. Some of those businesses are also accounting businesses, businesses that sell almost exclusively life insurance advice. And those kinds of cohorts, accountants and life insurance advisors, are complaining about the general nature of the education they have to perform. They're specialists in one or two areas, but they're being asked to sit exams that test their knowledge across the whole spectrum. So it's a little bit like an eye surgeon being asked to set a GP exam, and they're not particularly happy about that. So it's certainly one of the reasons that people are leaving the industry.
Now, turning our attention to an aspect that, of course, the startup community is interested in, sophisticated investors. I want to talk to you about the definition of that and whether we need to test sophisticated investors about their credentials.
Yeah, I think the current market falls testing that notion of sophisticated investor. Just replaying, of course, the criteria or the standards by which people are defined into that camp. So sophisticated or wholesale, those terms are often used interchangeably. So you've got to have $2.5 million of net assets or $250,000 of income over a 2-year period. Now, a lot of people pass that asset test because of their property values, which has skyrocketed over the last 10 or 20 years. So arguably those numbers are needing a reset, and I think the whole notion, though, of testing people on their level of sophistication by looking at their wealth is completely wrong. You know, the test needs to be a little more intelligent than that. It probably starts with financial literacy, although I'm not sure that financial literacy is the be-all and end-all. I think that's a starting point. It needs to go into some more depth around a person's behaviours and how they actually respond under stress in financial markets, looks at their ability to deal with complexity, particularly in product, their ability to have their risk appetite, and they're also their ability to deal with ambiguity, which is, as we know, for most people, markets are really difficult to determine and understand directions. So dealing with complex information, ambiguity, are all parts of whether or not I think you meet a sophisticated investor test. There is also, just if I keep going, there is some legislation too that that has come out. It's back to the FASEA standards, the Code of Ethics. Very clearly states, though, that an advisor needs to take into account the ability of the client to understand, to have financial literacy, regardless of their wealth. So whether that person does meet a technical test on asset levels or income levels, the advisor still needs to determine if they can understand the situation.
Which is a lot of responsibility to be put on an advisor, particularly accountants, because, when it comes to the definition of sophisticated investor, it carries a whole bunch of new risks associated with that client, doesn't it, for the actual advisor accountant?
It does. I think it's hard enough probably for an investor to assess whether they've got a degree of financial literacy and sophistication to meet that test, let alone an advisor who's got to interpret that. So challenging. Other legislation has come out that's called the Design and Distribution Obligations Act. That the actual rollout of that legislation has been pushed back into late next year. But it's new legislation that puts now a new onus on financial product manufacturers to take some responsibility in the way in which those products are matched up with the ultimate investor or client. So a suitability test, and I would expect some kind of matching around sophistication too.
All right, Mark, it's always great to get your thoughts on this matter. We really appreciate your time. We'll see you soon.
Thanks, guys.